Podcast Network Asia.
You are listening to First Metro Securities Philippine Stock Market Weekly podcast, where we feature timely and relevant discussions on the Philippine stock market and the economy in the hope of providing you investing and trading guidance. Here's your host.
Hi investors, this is Anjz from First Metro Securities and you're tuned in to Market Bites. Today, we're taking a closer look at PLDT Inc. or TEL. Joining me once again is my colleague Sam, and she covers the telco sector. Hi Sam, welcome back to the podcast.
Hi Anj. Hi everyone. It's great to be back.
Let's jump right in. Sam, what's our take or our house call on TEL?
So we actually like TEL right now. We're maintaining our buy call, and we actually raised our target price to 1,650 from previously 1,540. So we basically just rolled over the valuation based on next year, but our core investment thesis remains the same. So TEL is one of our top picks for 2026, and we really like it for its dividend yield of 8.1%. So that's pretty much a no-brainer right now, given that it's higher than both the 1-year and 10-year Philippine government bond yields. So what's more encouraging is that TEL has returned to positive free cash flows. So this has reduced the risk to your dividends, which has been a pretty long-standing concern of many investors for PLDT. And we think that there's actually a path now for your dividends to actually even increase in terms of your payouts over time, especially as the balance sheet improves. So perhaps more importantly, we see a clear path to deleveraging, which addresses one of the market's long-standing concerns on the company.
That's a great overview. What's driving your confidence in TEL?
So at the core of our view is the company's improving free cash flow, and as well as its ongoing debt reduction. So we note that TEL's levered free cash flow, this is your cash flow minus capex, and then after your interest payments and as well as your debt repayments. So all of that subtracted, it has already turned positive as of the first quarter of 2026. So that's a very encouraging sign. We do think that this is sustainable throughout the year, supported by your stable EBITDA growth and disciplined capex management. So management thinks that they can keep capex below 55 billion by 2026. At the same time, management also thinks they can lower debt by around 12 billion this year. So that's an encouraging number for us. And putting those together, we project that your net gearing or your net debt to equity would be improving from 2.2 times in full year 2025 to 2.0 times in 2026 and 1.8 times in 2027. So for investors, that's really important because your lower leverage means you're more financially healthy and it provides a stronger support for your company's dividend policy.
Another major development is the upcoming Vitro REIT. Why is that significant for TEL?
It's really important for TEL because it gives it a new avenue for capital recycling. So what it can do is recycle its mature infrastructure into newer avenues for expansion as well as debt repayment. So basically, PLDT has filed for the listing of its data center arm, which is Vitro REIT, and the sponsor will be ePLDT, which is also a wholly owned subsidiary of PLDT. So the REIT's initial portfolio will be 8 data centers with around 24 megawatts of capacity. So the company is targeting gross proceeds of up to 24.2 billion pesos, and management actually guided that they can use this money in order to repay debt as allowed by the expanded REIT law. So they will also be using this money to support future expansion of the REIT. And in our opinion, Vitro's more than just a new listing. It's a tool that can help accelerate balance sheet improvement.
And beyond the IPO itself, what's the broader growth story that our investors should pay attention to?
The key point is that Vitro creates a long-term capital recycling platform. So as you know, right now, they're looking at a data center REIT. But in the future, under the expanded REIT framework, PLDT can potentially inject other digital infrastructure assets. So that includes your cell towers, your fiber backbone, potentially. And they can do this over time. So that allows these mature assets to be monetized while also freeing up some capital for growth investments as well as some balance sheet repair. In practical terms, there's a three-part benefit. So firstly, your immediate IPO proceeds can be used to pay down debt, as I mentioned earlier. Secondly, PLDT will be enjoying recurring dividends from Vitro, so that provides them some additional cash flow. And finally, your future asset infusions can also help fund network expansion without burdening the balance sheet. So taken together, we do think this creates a credible medium-term deleveraging path for TEL.
You've already touched on the expanded REIT framework, but there are also several regulatory developments, right, that could provide additional upside. Can you walk us through those?
Yeah, sure. So there are three key regulatory developments that we're watching. So the first would be the expanded REIT law. So as I mentioned earlier, this now gives your sponsors more flexibility in terms of how they want to use the proceeds from their asset infusions. So that includes debt repayment, as I mentioned earlier. And now, it also broadens the range of eligible assets to include your telco as well as ICT infrastructure. And then the second one is the Konektadong Pinoy Act, or the KPA. So this one allows expanded infrastructure sharing. So this one could create leasing opportunities for PLDT. And over time, the assets that they are leasing, so again, as I mentioned, those fiber infrastructure, your backbone, and your cell towers, they could all become candidates for future monetization through the REIT infrastructure. And the third and final one that we're watching is Executive Order number 119, series of 2026. So this is basically a newly enacted data sovereignty decree. This requires government data to be stored within Philippine jurisdiction. So management estimates this could generate an additional 200 to 300 megawatts of data center demand. So currently, we only have around 200 or less than 200 megawatts of total capacity in the entire country. And EPLDT, which is Vitro's sponsor, already accounts for roughly 1/3 of that. So we do believe that PLDT is well positioned to benefit from this trend.
Let's talk about earnings. The first half earnings season is already underway. How do you see TEL's earnings profile shaping up?
So we do think that TEL has a pretty defensive earnings profile with some recovery upside. We're forecasting growth of around 1.7% in full year 2026 and 5.1% in full year 2027. So this is largely supported by PLDT's leadership in the fixed broadband market, where it held around 43% of total subscribers as of the first quarter. So its large postpaid subscriber base, in particular, helps provide some stability, especially in a softer macroeconomic environment. On the broadband side, we are also expecting fiber momentum to continue picking up following the completion of key system upgrades earlier this year. So just for some context, those upgrades really put a pause on subscriber activations in the first quarter, which temporarily weighed down on your subscriber additions. So management also expects the new system that they implemented to include some AI-enabled capabilities. So we do think that this will improve their efficiency. Meanwhile, lower inflation could help support a gradual recovery among their more price-sensitive prepaid users, especially in the mobile space.
So, looking ahead, what would make us more constructive on TEL?
So there are several developments that we're watching. First, we would like to see if the impact of the Konektadong Pinoy is much less than we anticipated. Second, we do want to see some continued strength in their fiber, especially if TEL accelerates growth in their prepaid segment. Third, we do want to see some stronger data monetization, which should support a recovery in their mobile revenues. Fourth, sustained positive free cash flows. So we want this to be driven more and more by stronger profitability. And fifth, we do want to see faster growth in terms of their enterprise revenues, especially coming from their data center and managed IT services. And finally, we want to see potential re-rating of Innovations holdings. So following the anticipated IPO of GCash, as you may know.
Of course, every investment has risk, right? What would be the factors or the key risks that investors should watch out for?
So the main risks that we're looking at, firstly, again, as I mentioned earlier, the KPA, if competition is more intense than we expected. Secondly, as you may have heard, there was a recent development with your digital payment apps that, for example, they lowered their transfer fees.
Yeah.
Especially Maya, I think they lowered it from 15 to 10 pesos. So we want to see if that has a bigger impact than expected on its earnings. And finally, if there are some more market share losses in terms of their mobile, So that we do think that could lead to some more pressure on their mobile revenues.
Before we wrap up, what's your key takeaways for our investors?
So ultimately, our investment thesis for PLDT comes down to its improving dividend outlook. So as you know, the yield right now is at 8.1%. That's pretty much a no-brainer for you to pick up right now. So we do think that the return to positive free cash flows, its ongoing debt reduction, as well as some opportunities to recycle their mature assets into future REIT should point to a healthier balance sheet over time. So overall, we do think that this puts a very strong case for you to buy PLDT right now, given that 8.1% dividend yield.
Great insights, Sam. Thank you for joining us today.
Yes, thank you so much for having me here.
And that wraps up our episode for Market Bites. To everyone watching on YouTube or listening on Spotify, we hope this has been helpful. If there are any stocks or topics you'd like for us to cover, feel free to message us on our socials. We're on Facebook, Instagram, and YouTube. That's First Metro Securities, and on TikTok at FirstMetroSec. Thank you everyone for tuning in, and we'll see you on the next episode.
Thanks for listening to First Metro Securities Philippine Stock Market Weekly podcast. Don't forget to follow us to get first dibs on our new episodes. For more up-to-date market news and info, exclusive content, and the opportunity to connect with your fellow Filipino investors and traders, join facebook.com/groups/FirstMetroSec and be part of the First MetroSec family.
First MetroSec is providing this podcast as a general market commentary. Reference to any specific security, product, or entity do not constitute as an offer or a solicitation of an offer to buy or sell any financial instruments or to participate in any particular trading strategy. The statements, comments, views, or opinions expressed by the hosts are subject to change without notice, and First MetroSec is under no obligation to update, amend, change, or correct any of the statements, comments, views, or opinions expressed. The statements, comments, views, and opinions expressed by the guests are their own and do not necessarily reflect the view of First MetroSec. First MetroSec disclaims any liability arising from reliance on or reference to any information obtained in this podcast.
The views and opinions expressed by the podcast creators, hosts, and guests do not necessarily reflect the official policy and position of Podcast Network Asia, the hosts of the program, or other programs of the network. Any content provided by the people on the podcast are of their own opinion and are not intended to malign any religion, ethnic group, club, organization, company, individual, or anyone or anything.